Hey guys, Jeff with optionboxer.com. Back today with a backtest video focusing on covered calls. Before we get into that, please know that this is not a recommendation for you to buy or sell any security or place any trade. Please make sure you're doing your own research prior to trading. And I'll mention this again at the end of the video, but there's a lot of data kind of passing between the Thinkorswim platform and me hand entering that data into the spreadsheet. So data entry errors are certainly possible, and while I've tried to be as thorough as I could, mistakes do happen. So again, please don't blindly trust this data, but it is fairly eye-opening, and I think you'll see that once we get through here. So the first thing I want to say is this video may be a little bit lengthy, so prepare yourself for that on the front end. And if you're looking at this covered call spreadsheet and you've never seen it before, I'll leave a link to it in the description. I have it available for free on my website at optionboxer.com. But just I'm not going to run through the spreadsheet because I've done that in another video, which you'll be able to see once you click on the link in the description, and it'll tell you all about how to use this and what all it can do and what it can't do. But let's go ahead and get into the back test. You'll see all these different tabs down here are the different back tests I attempted, and then we'll of course finish up with that review there at the end. But the first one I tested, you'll see I've got right here in green on all the different pages what the back test was and how I approached it. For this back test, it was conducted from January 2020 through December 3rd, 2021. So essentially two full years, and the period was particularly unique, and the reason I didn't do a further back test is because it would have taken longer. But this period was unique because we did have the coronavirus sell-off, which as you probably know it included a pretty serious market decline. So for this data to come out positive was surprising. But with the covered call, it's kind of marketed, it's sold to you by most brokers as a safe investment or safer investment strategy. And so I wanted to put it to the test and see what worked and what didn't work. And I think you'll see once this video is complete that you like me may have been trading the covered call wrong all along. So the first thing we did was the first back test I attempted was I wanted to sell calls 5% away from the current price at about 30 days to expiration. And then I was going to re-enter the position at whatever the market price was as soon as the shares were called away. And you can see the back test data here. I'm not going to go through all that. But more or less the key takeaways from this particular approach were it was more work to enter the positions each month. And ultimately a less reward. If I had just bought and held the shares of Bank of America, and I should also say all of these back tests are conducted on Bank of America. At the end, I attempted one on Kraft, Heinz, and I picked a couple of different ones that I was going to back test based on the fact that they pay a dividend that is generally pretty good, and they're fairly stable companies. So Bank of America, I started out and I bought 100 shares at $35.61, and then immediately started selling calls 5% away from the money. And the way I used it is I just gave myself a little calculation here to give me the target strike price, which was again just out of the money. Capital was tied up until December 3rd, and that becomes relevant here in a minute when you look at some of the other approaches to the covered call strategy. And then consistently increasing risk as shares have to be purchased at higher and higher. The market started to rally. I had to buy shares at an increasingly higher cost, all the way up to as high as looks like $44.53 at the highest. So not ideal in that scenario. And then my ultimate, takeaway was I cannot currently see any scenario where this approach makes sense. Buy and hold outpaced the covered call performance by 90% over the same period, assuming my percentage calculation is correct there. But you can see right here, the return on investment was 28% to just buy and hold the shares, and then the return on investment doing the covered call was only 12%. Worth noting, though, is that they were both positive. I should also say that right after the coronavirus, we saw a huge bull market take place, and most if not all, I'm sure not all of them, but many companies were able to climb back over their peak before the coronavirus pandemic. And so that's worth noting here. That doesn't typically happen. So this strategy, in my opinion, was a loser, and it's not the way I would trade the covered call. But it is, so it is a way I've traded the covered call in the past, selling just out of the money or slightly out of the money, thinking that because I was collecting premium, at the end of the day I'd be returning more on my investment, and that's simply not true. Just buying and holding would have returned you more. So the next test I did is I wanted to sell calls 10% away from the current price at 60 to 90 days. So essentially the same strategy. I'm just going to move the strike price further out of the money, and I'm going to sell it just to collect a little more premium. I'm going to sell it a little bit further out in time, so 60 to 90 days. And then again, same thing. I'm going to re-enter the position at the current price if the shares are called away. And you can see at the highest I paid $42.54. Again, the buy and hold strategy. This one I actually ended on November 19th just because the shares were called away, and I wanted to keep all of them within that December 3rd timeline, and so there just wasn't enough time to open another call and have it expire or get called away, or have the shares get called away. So you can see in this particular scenario, buy and hold was a return on investment of 31%, and then the covered call strategy was only 11%. And just like the previous strategy, the key takeaways are much the same. The capital was tied up a little less time, consistently increasing again the cost to purchase the shares. And again, my final takeaway was I can't currently see a scenario where this approach makes the most sense. And the buy and hold outpaced the covered call campaign by 143%. So again, not an ideal strategy, but again, worth noting is they were both positive, buy and hold and the covered call campaign. So for my next strategy, I actually ended this one on September 17th, and that's because it was called away. And since I was doing 60 to 90 days, again, it just didn't seem like enough time to be able to let the shares get called away or for the call to expire worthless. So I was going to sell calls at a profit target. This was kind of a revelation for me here, is I was just going to identify a profit target, any target that I thought was acceptable. Something relatively close to the current market price, just so I was able to collect a little bit of premium. You can see here early on the premiums were pretty thin, but I put in there, as long as it was over 10 cents, I was going to sell it, and so I did. And then I was going to end the campaign if the profit target was achieved, and the profit target in this instance was $40. And you can see my initial share cost was $35.61. So it wasn't I wasn't anticipating a huge rise in costs or a huge rise in price. Only about $4.39, I should say. And but it did take me a while to get there, as you can see, because we did have the coronavirus sell-off. But in this instance, the covered call campaign actually netted me 27%, whereas the just buying and holding over the same period only returned me 18%. So key takeaways were there was less work because there was less management to be done. Capital was freed up to 3 months earlier. There was no need to continually increase the risk at a higher share price, and it was a winning approach to covered call writing. The next approach, I actually abandoned it early. You can see here I put a note to myself. I abandoned this strategy early because the negative result was kind of compounding itself. January 2nd through April 30th of 2021 is all the data I have here. But you can see there's a lot of data entry over here. So there was way too much work for no long-term reward. You can see the covered call campaign using this strategy. I was going to sell calls 5% in the money at 30 days to expiration, thinking maybe I would get some downward movement, and I was going to close at a 50% profit, or I was going to close the call at a 50% loss target. And the only way I let shares get assigned or called away is if the profit target or loss target wasn't hit throughout the life of the contract, and it was in the money at expiration. So again, I was looking at a 50% profit target or a 50% loss target. And you can see I've got those calculated here just so I knew what to put over in this area. You can see again on the life of this, the return on risk was negative 5%, or I lost $176 over the period. Again, just buying and holding the shares over this time frame would have yielded me 18%. So buying and holding would have again been the better alternative. So it gets a little bit more interesting here, and I was able to use this data to kind of run a couple of different tests. But this one I ran all the way to December 3rd, and I was going to sell calls 10% out of the money at 90 to 120 days to expiration, and I was going to close them at a 75% profit target or a 75% loss target. And when I say 75% loss target, I'm talking 75% of the credit receipt. But we can look down here and you can see the total campaign. So you can see I would have collected all of the dividends, assuming on X dividend date. I think I made a mention of that. Assuming on X dividend date, the shares weren't assigned. If it wasn't in the money on X div date, I didn't take that into account during the test. So please be mindful of that. So I'm assuming in this scenario that I collected all the dividends and it would have returned me 17%, closing at a 75% profit target or loss target. Again, buy and hold would have been the better scenario. But if you account for a stop loss, because if you look through this data here, and if I had entered a stop loss at the time I placed I sold the covered call, if I had entered a stop loss on the call contract, my numbers would have been a little bit better. I actually would have returned 29% versus 28% if I just bought and held the shares. And so it would have been a little bit better. Now, again, with a stop loss, you never know if price may gap against you. And so you may not get the price that you want to fill, but it would be a lot closer than just because the way I managed it is I managed it on Fridays. So maybe on a Wednesday or a Tuesday, the price, the stop loss would have hit, and it would have triggered to close the contract at the target price. So if I had done that, it would have been a little bit better return at 29%. And I also took a look at it if I did this using the stop loss parameters again. With a 50% profit target and a 50% loss target, and you can see the return on investment would have been 30%. So those stop losses would be critical if you were going to approach the covered call in this way, where you wanted to close the call at a certain profit target or a certain loss target. Those profit target orders and those stop loss orders would be paramount to seeing a better return on your investment. Just take a look at my key takeaways just so I don't forget anything. Without a stop loss, this strategy would yield substantially less, which I mentioned. No risk of increasing share costs because you're basically just buying it once and you're closing because you have such a large time frame. More often than not, it's going to reach the target before it gets to expiration. There was no cost basis reduction because of the losses on the short calls. You can see down here, I had a net loss on all my short calls, so I didn't receive any cost basis reduction. In fact, my cost basis is actually higher, so that's a pretty big deal. The buy and hold outpaced the covered call without the stop loss by 62%. But 75% covered call with the stop loss outpaced it by the buy and hold by 4%, and then the 50% covered call strategy campaign, I should say, with the stop loss outpaced the buy and hold by 7%. So, and then again, this strategy was up to September 17th. I was going to sell calls at a profit target, which we identified a moment ago was the most advantageous approach. At 60 to 90 days, call premium again greater than 10 cents. And I was going to end the campaign if the profit target was achieved at any point, which it was on September 17th. The only difference here is I was going to buy a protective put 5% from entry, and I did at 379 days approximately. I can't remember the exact time frame or the exact days to expiration, but I bought a kind of a leap protective put at 5% away from the current price, or as close to it as I could with the strikes that were available. And then I was going to exit the protective put if there was a 25% market retracement. And you can see there was, because again, we had the coronavirus sell-off. And so you can see I was able to get out of this at a huge profit. And that actually bolstered the returns here. And you can see some of the key well, actually, let's take a look here first. You can see this covered call campaign with the protective put would have yielded me 40% return on my investment versus 18% over the same time period, just buying and holding the shares. Would only mildly erode the key takeaways here. The protective put would only mildly erode the profits in the event a sell-off didn't occur. So it was only $204 to buy the protective put, and it offered you downside protection. So the most you could have lost in this particular scenario would be the difference between 35 and 32 value. But in this case, because the coronavirus pandemic happened, it did go up in value. And so even if it didn't, it would only mildly erode profits. Should the sell-off occur, as it does here, like I said, it would boost the bottom line by approximately $500, in this case by $491. And like I just mentioned, should the market never sell off, the hit to the bottom line would be $204, or the premium or the debit you paid to enter the protective put. The return in that case would be $746, which is still above just buying and holding the shares by 17%. So even if I bought the protective put and did nothing else except run this strategy using the profit target, I would have still returned more than if I just bought and held the shares. So that's definitely worth noting. The answer, I guess, here for this, if you wanted to utilize this strategy, or if you were considering this strategy, would be: do you expect, or do you suspect a market sell-off will occur during the life of the campaign? And I think if you're anything like me, you always suspect the sell-off is going to occur. So it almost makes sense for me every time to use the protective put. But it's here for your consideration. And then from a protection of capital standpoint, again, this is a clear winner in my opinion. So like I said, that's the way I'm going to do it going forward. I haven't really done that at this point in my covered call writing, but I probably will going forward now that I've seen some of the data. And so this test I ran from March 26th, and I ran this through February 19th. The only difference here that I can remember is I was going to use technical analysis to determine my entry point. Whereas the other strategy that I just basically bought the shares and started trading the covered call campaign. In this situation, I'm going to open a position when price bounces off of a standard deviation channel, and when the price crosses above the 9 EMA line. And I'll just go ahead and pull Thinkorswim onto the screen really quick so you can see this technical analysis at work. And I was using the 1 year, 1 day chart. So let's just find something that I don't have any positions on. So basically what I did, and I could go back, but all I did was I waited for price to bounce off of the coronavirus pandemic. It got all the way down here to the 3 standard deviation channel line. So once price bounced off and it closed above, and I'll zoom in so we can see it, this blue line. Once price bounced off here, and then if I was looking to trade the covered call on Apple here, on this day right here, which is 10-14 of 21, I would have gotten in. And you can see, had I done that, it would have been a nice time to start a covered call campaign, because my profit target more than likely would have been achieved. So again, all I was doing was using the standard deviation channels, and then you can confirm that if you're interested to. You can confirm that that it's bottomed out if the RSI is already in an oversold condition. For this particular approach to the covered call campaign. And then I was going to sell calls at the 60 to 90 days, which I think I said, again, maintaining at least a 10-cent premium. And I was going to end the campaign if the profit target was achieved. My profit target in this scenario was going to be 30, because you'll notice that my entry cost on this particular strategy was $22.33, which essentially meant that I waited until the bulk of the pandemic decline had happened. And that's when I got the trigger to get in. And at that point, the share cost was $22.33. And I also bought a protective put at approximately 379 days to expiration. Again, I don't remember the exact time frame, but it was a leap. It was at least a year out. And so again, 5% out of the money there. And then I was going to exit the protective put if a 25% market retracement did occur. So a couple of things to note here is it would require minimal maintenance. And probably the easiest way to do that would be just to track the price highs. You find the trend line tool. So from here, just go down to where you see that percentage in that box there. Just draw you a 25% more or less. And if price reaches this low, you'll know that it's time to close that protective put. So that's the way I would do it. And then anytime there was a new high made, I would just move that line to the appropriate area. So that's just a quick way you could do it. There's probably 100 other ways you could go about it, but that's how I would do it, because it's quick, it's simple. But there would be a little bit of maintenance there to make sure you're monitoring that protective put. The capital at risk for only 11 months in this strategy versus 21 months for other tests. It was a successful covered call campaign, even with the total loss of the protective put, which you can't see here because I deleted it out so that I could give you this data without the protective put. And then outcome may be untypical given the immediate rise in price. Again, like I mentioned at the beginning of the video, typically when there's a huge sell-off, price doesn't immediately bounce back within the next year and recapture its old highs. That's fairly untypical, and so just keep that in mind as well when you're looking at this. But if you look at the data here with the protective put, you would have returned 29% over the time period, which again was the 26th of March through February 19th. However, worth noting is if you had just bought and held the shares using this technical analysis approach, you would have returned 58%. So, a huge difference there. And again, a lot of that is because we had the protective put, and that protective put probably cost us $200, $300, $400. You can see without the protective put, we would have returned 44% over the time period versus 58% buying and holding. So again, buying and holding seems to be the clear-cut winner. Also worth mentioning is just buying and holding the shares is considerably easier because there's really no maintenance requirement. I mean, basically just buy it and let it do what it's going to do. And then just to kind of highlight the fact that it does work on other companies. I did this one test on Kraft Heinz, which is essentially the same test. And again, you can see the blank line here because I did have a protective put there, but everything else is identical. The one other takeaway I wanted to mention there was that technical analysis can dramatically improve, sometimes dramatically improve the performance of the covered call strategy. From September 30th, 2020 on Kraft Heinz, which was when I got the trigger when it bounced off of the. In fact, I skipped past, now that I'm thinking back, I remember this. I skipped well past the coronavirus pandemic because I wanted to give maybe more typical data. So I got to September 30th before I got the next indication. But you can see the return here with the protective put would have been 12%. Without it, just buying and holding would have been 19%. And if we hadn't bought the protective put, we would have returned 18% versus, again, just buying and holding at 19%. So I think all in all, the best way I think I found to trade this is if you suspected a market decline, is to have that protective put in place. If you didn't suspect a market decline, if you thought the market was stable, which I don't know that I've ever felt like the market was stable, but if you did feel like it was stable, the absolute best approach to trading the covered calls is trading it with that target in mind. But you can see I pulled all that data in here, and then test number one was way back at the beginning was the 5% away or 5% out of the money, and you can see buying and holding won that one. Test number two was the 10% out of the money. Again, buying and holding was the clear winner. Or test number three was the one where we picked a profit target, and then kind of a note I had here: utilizing a target sell price is the only effective way to implement a successful covered call campaign. Test number four I've got right here. Sell calls 5% in the money. That should never be done. I know it's maybe a little bit alluring because you think you're getting a higher premium. And again, I had a target to close at 50% or 75%. I can't remember which, maybe both. But in either scenario, it was a loser. So it's definitely the worst of all the strategies. Was selling a call in the money and owning the shares. Test number five is I was going to sell 10% out of the money, except I was going to go longer time frame, and I was going to give myself a 75% target. And you can see that didn't really work out either. It was profitable, but it wasn't as profitable as just buying and holding. Test number six, there wasn't enough of a profit margin, in my opinion, to be worth the risk of making a mistake entering the covered calls. So buying and holding was the winner there. Test number seven, which I believe, is just another variation of this. And same note here, not enough of a profit margin to be worth the headache or the hassle of entering the calls and running the risk of possibly entering an order incorrectly while you're searching for a profit target or a stop loss. Test number eight is sell calls at the profit target at 60 to 90 days, and then going to use the protective put in this instance. And you can see that the protective put, because I did calculate this over the coronavirus sell-off, which is not typical, it was a huge winner because the protective put returned such a large amount. Test number nine, sell calls at the profit target again at 60 to 90 days, again using the protective put, and then exiting at 25% market decline. You can see here, test number 9, the buy and hold was the winner. That was the one where we used technical analysis. And then test number 10 was the same, using technical analysis. The only difference here is this time we didn't use the protective put. Test number 11 is we were going to sell calls at the profit target 60 to 90 days to expiration, using the protective put. Basically the same approach, just using Kraft Heinz, and then again, this was without the protective put. So you can see we had an 18% return without the protective put. We only had a 12% return with the protective put. But again, in both scenarios, the buying and holding would have been the better strategy. So just my final thoughts. In the end, the only clear way to implement a covered call campaign successfully is to target a certain share price. So no more buying and buying shares at whatever market price and then just selling a slightly out of the money call. While that is still profitable, over a couple of years or longer possibly, you get more bang for your buck by targeting a certain price and selling covered calls at that price until that target is met and your shares are called away. This target will need to be relatively close, again, like I mentioned a while ago, so that the premiums are still attractive. Again, these were on smaller companies, and I chose these because they paid a nice dividend. Their dividend yield was relatively high, and so I wanted to calculate with the dividends as well. Should the market ever start to look scary, you could always open that protective put, and I put in there as a sleep aid, in case you were worried about it. The test should be conducted across a wider range of market environments, and then the data entry errors, like I mentioned at the very beginning, are certainly possible. I was moving a lot of numbers back and forth from the platform into the spreadsheet, so there could be some discrepancies here that I may not be aware of at this moment. And then lastly, it's worth noting that in every test, simply buying and holding returned a profit. You can see buying and holding was profitable every single time, and that requires absolutely no management. So while there are scenarios in which you can return more using the covered call campaign, you have to be very specific and very disciplined in your approach to return more than just buying and holding the shares. So make sure you kind of take that into consideration before you start your next covered call campaign. But that's it for this video, guys. I wanted to share all that with you. It was fairly eye-opening for me. I hope you guys felt the same. I'll try to chapter up this video so that it's maybe a little easier to digest, and you can find the test that you want to see. But if you like the video, or if you like the videos that I've produced in the past, or if you like the spreadsheet, please do like and subscribe to the channel. It really helps me out. All right, guys, thanks for watching. See you next time.